Are you constantly refreshing the stock ticker that you just poured a boatload of money into, waiting for it to either hit big or potentially go to zero? Do you not want to spend countless hours listening to earnings calls and researching stocks? Well, luckily with ETFs, an investor can just buy into a giant basket of stocks and avoid any work, as an experienced fund manager will handle all the important decisions for you. In today's video, we will look at SCHG, the Schwab US Large Cap Growth ETF. Now, I have previously reviewed SCHD, which is the Schwab US Dividend Equity ETF, and I'd say that's probably the best dividend ETF out there if one wanted to invest in some great blue chip companies and collect those dividends. But let's see if this large cap ETF can outdo its Charles Schwab brother. So the main goal of this ETF is to track the total return of the Dow Jones US Large Cap Growth Total Stock Market Index, whose goal is to measure the performance of large cap US equities that are classified as growth based on their criteria that Standard & Poor's sets. Now, some of those factors include projected earnings growth, trailing revenue, trailing earnings growth, dividend yield, among many others. This ETF had a portfolio turnover of about 6% this past year. Now, the holdings will get rebalanced every quarter starting in March, and the weighting is done on an adjusted market cap basis. It's actually done very well in the past 10 years, returning on average 17% each year. The median market cap in this 226 company index is $25 billion, with the largest company being just under $3 trillion. I think we all know what company that's going to be. Now, going back to SCHD, the goal is to provide a diversified portfolio in companies and sectors. But this is also going to be able to capture companies that exhibit growth style characteristics. Now, what exactly is a growth stock? This would be a company that is anticipated to grow at a rate that is significantly above the market average for growth. Generally, growth stocks, they don't pay dividends, or if they do, they're often pretty low yields. This is because the company is more focused on putting profits back into the business to continue to grow across different segments and get more market share. Investors love growth stocks because of the crazy capital appreciation that can happen. However, because of this, growth stocks often trade at high valuations and they look very expensive with their PE ratios if they're lucky enough to have a PE ratio. Essentially, investors are willing to pay high premiums now because they think the stock will eventually keep growing in the future to make those premiums that they pay today worthwhile. Though, if those lofty expectations are not met, expect that share price to come crashing down. But because this ETF invests heavily into large caps, these are typically companies that are much more mature and not able to reach the same level of growth as those small or mid-cap companies. Let's take a look at what those companies are going to be, because it's going to be very top heavy because it's market cap weighted. Apple makes up 14% of the portfolio alone. Microsoft is at 12%, Amazon is at 7%, Tesla, the two Googles, and Nvidia are all about 4% of this portfolio. Then there's Facebook, UNH, and Visa at around 2%. So right there, these top 10 holdings, they make up nearly 60% of the ETF. Again, it's very top heavy. That means that the other 217 stocks make up just 40%. Now, I personally don't like any position in my portfolio to be bigger than 10%. Even if it's an amazing company like Apple, one day it could potentially get toppled. For reference, the largest company in the 90s was a company called General Electric, and in 2009, the largest company in the world was ExxonMobil. Now, I don't think any investor today would sleep very well at night knowing that 15% of their wealth was tied into those two companies. Just because Apple is the king today, that doesn't necessarily guarantee that they won't be the peasant tomorrow. Now, unlike SCHD, which really focuses on dividends and dividend growth requirements as part of its criteria, that is not the case with SCHG. Clearly, with 6 of their largest holdings, they don't even pay dividends. But what makes this ETF so amazing is their 5-year earnings growth is 32%, which is just absurdly amazing. Almost as amazing as you hitting that like button and subscribing to the channel. It really does help out a small-time YouTuber and lets me know that you're enjoying the content. Now, the sector breakdown is heavily skewed toward tech, with about 50% of its holdings in tech, and from there, communications, consumer discretionary, and healthcare are all less than 15%, but greater than 10%. So we're still getting that good old diversity, but still, the big emphasis is on tech. And that's no surprise. Since 2007, the information technology sector has destroyed the other sectors, returning over 900%, nearly 400% better than second place consumer discretionary. So if I wanted to be heavily invested in one sector, it would definitely be in technology. But also at the same time, I know this wonderful run-up that we've had this past decade, that won't be the norm. Eventually stocks will be flat, or they will have to live up to all these big expectations that have been put on them. And I do think that we will see a period where stocks will just be flat or they will decline. And to be honest, I think we might already be seeing that. There's only so many times Apple, a $3 trillion company, can increase revenues 30% year over year. So sometimes it's nice to just get paid those dividends while we wait. Speaking of dividends, this is a company that pays less than a 1% yield at around just 0.80%. Again, this is an ETF one would buy if they wanted to have a nice pool of large cap growth stocks, not necessarily a basket of blue chip, high yielding dividend companies. Now, SCHG, they have paid consistent quarterly dividend payments since their inception in December of 2009. But the dividend growth is really not there. They went from just 47 cents in 2011, 2012 to paying out just 69 cents in 2020. Now, while we all probably want to get more exposure to 69, the sporadic payments these past 10 years, really, they just have no rhyme or reason. I really do like predictability when I buy my dividend stocks and ETFs, and if I was dependent on this ETF in retirement, I wouldn't really like this unpredictability. Now, I already know you and your grandma want to know how this ETF is taxed. According to their prospectus, dividends and capital gains distributions will generally be taxed as ordinary income or capital gains unless in a tax-advantaged account like an IRA. Now, because this fund doesn't do any options trading, and they likely for the most part practice long-term buy and hold, most of those dividends, if I had to make an assumption, would get favorable tax treatment, unlike some of the other ETFs I know. Now, SCHG, they have outperformed the S&P 500 over the past 10 years, giving us 17% annual returns versus the S&P 500's 14.5% annually. Did I also mention the expense ratio is a mind-boggling 4 basis points? That is a whole $4 fee for every $10,000 invested. That is so cheap that it should have its own episode of Extreme Cheapstakes. That is an absolute bargain, because if you tried to buy these stocks on your own, that would be hundreds of thousands of dollars and so much time and effort. With just $75, one can get a small sliver of each of these companies and have to do no work and get some great returns. Overall, I am very impressed with this ETF. It seems like Charles Schwab, they really do offer the best products. No wonder this particular ETF has over $17 billion in assets under management. This is a great complement to have with SCHD. This ETF is giving you that great exposure to some amazing growth stocks, while SCHD will give you exposure to some of the best blue chip dividend stocks out there. Now, if there's ever an ETF that you would like me to make a video on, just let me know in the comments below and I might just get to it. As always, my videos are found in podcast form under the Collect Cash podcast name. And make sure you like, comment, and subscribe, and I will buy, stash, and collect cash you later.